Hello, everyone, and welcome to another episode on the Fund Manager's View. Today, we have with us Mr. Sachin Shah, Executive Director and Fund Manager, MK Investment Managers Limited. Welcome to the episode, Sachin.
Thank you.
So, we would like our viewers to know certain insights from you today. So, first question for you: how do you view the current global and Indian economic scenario?
Well, if you just see the recent months, right, the last 2-3 months, June and July has been very good for both the domestic and the global markets, particularly the domestic markets. August has also been, I would say, a bit of a consolidation, but we were still positive, which has been a good thing for the domestic equity investors per se. The important thing is that in the recent days, which is in the first 10 days of September, we are seeing some signs of consolidation, some signs of fears in terms of the global economy slowdown. And but of course, Indian equity markets still continue to remain fairly buoyant. I think one of the most important things that we are observing at this point in time, and which is what I think is a very positive thing as far as the Indian economy is concerned, and which is about the commodity prices cooling off, particularly the oil price. In the last 10 days or so, the oil prices have come off by nearly 10%. Now that's a very, very big positive for an economy like India, which imports more than 70-80% of its consumption or demand. We are also seeing cool off in some of the non-ferrous metal prices, which is aluminium, copper, lead, zinc. Of course, steel prices, ferrous has also been cooling off over the last 12 months itself, but now we are also seeing some bit of cool off in the non-ferrous. So I think commodity prices cooling off, inflation kind of trending down is, I think, a very big positive for an economy like India. And hopefully this doesn't turn into a major slowdown or a very, I would say, a hard landing kind of the fears that the world has today. I think we should be in a good shape.
Great. And in the Indian market landscape, which sectors do you see apt for the investors to dive in?
If you see our portfolio construct, and when I talk about this, I'm talking about our flagship product, which is MK Capital Builder, and like I've spoken in the previous shows also, where what we try to do is that we are generally playing a more of a secular theme, and we've been positioned fairly well. I would say three big sectors where we are fairly overweight. The first is the pharma sector. We've been overweight in this sector for a while now, and within the pharma also we've been very selective. So for example, we've been very positive on the CDMO space for more than 3-4-5 years, and we believe that it has now strong legs and very long legs. We are also seeing quite a few catalysts which are now coming into play. For example, the very recent the Biosecure Act, which is now on the verge of getting passed by the US Congress. I think that can be a very big catalyst, because that clearly again emphasizes the trend of China plus one. It is actually going to accentuate the entire trend. So CDMO space is something what we are extremely positive on. Other than that, of course, within pharma, even the domestic formulation space, we believe that's a very high sticky business with high margins, high entry barriers. So the leaders over there are getting stronger over periods of time. So that's one big space that we are very, very upbeat about. The other space is, of course, the auto and auto ancillaries. Of course, in the very, very last 2 or 3 weeks, I would say the domestic auto OEs seems to be a little bit under pressure in terms of the inventory pileup, particularly on the passenger vehicle side. But today, the kind of the demographic that this country has in terms of the young age population, and when you take the overall number of just about 4 million passenger vehicles, I think there is a very, very long road out there. So domestic autos is something what we are extremely upbeat. Again, even in auto ancillaries, the other thing that we are extremely upbeat is on the outsourcing story, right? So because Indian auto ancillary companies have proven that they have the domain expertise, they can deliver scale, and and to on a timely fashion. So I think that's again a mega trend that we are actually trying to play out there, very similar to the CDMO space. The third space, where I wouldn't say we are exactly overweight, but compared to the last 12 to 18 months, within the banking sector, the private sector banks haven't done as great as compared to their counterparts, which is the public sector banks. We believe that the whatever that catching up with the mean, or whatever one has to say in terms of the disequilibrium between the valuations, because at one point in time the PSU banking valuations had gone too cheap and probably private sector were too premium. I think that gap seems to have got kind of filled up over this time value correction over the last 12 to 18 months. So we believe the private sector banking and some of the leaders over there should also do quite well over the next 18 to 24 months.
Okay, great. With respect to rate cuts, they've been long due. So when do you see that taking place?
Again, this is a global phenomena actually, right? Whether we like it or not, it's the US Fed which sets the tone for the entire world, or rather most of the world, right? Of course, Japan has been a bit of an exception in the recent months, but largely speaking, it's the US Fed. Now, the point to note over here is, and this is what I personally believe, that the because interest rates at some point in time are linked to the inflation, right? And US Fed is also targeting it linked to the inflation out there. We have to realize one thing, that probably the inflation this time is far more structural than cyclical, right? So the historical inflationary rates may not be a sustainable inflationary rate from here on, at least in the developed markets. So of course interest rates will start cooling off, but the new normal will not be a very 0% or a 1% kind of an interest rate. Today US Fed is at 5.3. I think in the next 1 week we are clearly going to see at least a 50 bips cut or a 50 bips cool off, if I can use that word, from the US Fed. So, and the 10-year treasury yields in the US markets are already reflecting that. What used to be upwards of 4% just a quarter back or so, it's already dropped to 3.6. In fact, just 10 days back it was 3.8. We are now back to 3.6. So markets are already building some bit of cool off out there. But I think we have to be very sure that it's not going to go back to the 5-year lows or something like that. We will have the new normal will probably be a little higher than what we've historically witnessed.
And what impacts will the markets have if these rate cuts happen in this FY? And which sectors do you think will benefit the most?
No, like I said, that I think markets have already started factoring in a bit out there, because US 10-year treasury from 4% plus is now already down to 3.6. Even if the US Fed, which is the 5.3 current rate, even if they cut it down by 50 bips, it's going to be somewhere in the range of 4.75 to 4.8. Maybe in another next 6 months, it will come down in the range of 4. So I think a good part of that is already factored in by the markets at this point in time. If they don't cut, I think that might be a little bit of a negative surprise for the markets.
The banking sector is currently going a little slow. What do you think has affected? What factors?
No, I think this is a very classic cyclical thing, right? Every time this happens, whenever the interest rates go down or go up, during those phases, the ALM mismatch, asset liability mismatches, will always have some impact on the bank's P&L, and that is of course a function of every bank's positioning. That's point one. Number two, what is probably right now stretching a little bit to the banks is in terms of their credit growing, doing much better than the deposit growth, and that's why obviously their cost of funds are rising. But I think it's a good problem to have, because credit growth doing good means you have more business. And this is again a classic cyclical problem. There have been phases when deposit growth is much higher, but the credit offtake is not there, right? But I think over the last so many years, the banks are fairly well seasoned to manage this cyclicality. The good thing about the banking sector at this point in time, and which is I think much more structural, is the asset quality, right? The asset quality is very, very strong. We haven't seen any kind of challenges as far as the asset quality is concerned. Thanks to that, the credit cost is too much under control. So I think the PPOP growths, which is a function of your spreads or the NIMs, might be a little bit on a slow growth compared to your credit growth, but the credit cost which comes under the PPOP growth will actually make sure that the overall PBT growth or the bottom line growth, the PAT growth of the banks will be fairly healthy over the next 12 to 24 months.
Yeah, that's good logic. Financial services has the largest share in your portfolio. So which segment do you foresee leading growth in the sector?
So, actually, yes, it has one of the highest weights in our portfolios, but it's kind of not exactly our top pick. As I said, our highest weights are, overweights are rather pharma and auto, right? We have to understand that these weights are also a function to do with the benchmark index, right? Today, nearly 35 to 40% of the, or at least 30% now, earlier it used to be 40%, but anywhere between 30 to 35% is the BFSI weight in most of the indices, whether it's Nifty, Sensex or BSE 500, Nifty 500, right? Now, if you benchmark to that weight within our portfolio, I think we are fairly around that. We may be marginally underweight. So I wouldn't say that it's our top pick sector at this point in time, but it optically looks like the highest weight because by default the index has that a very high weight. You have to also understand that within that, of course, we are significantly overweight in the private sector banking, and exactly the points that I was making earlier.
Okay. In the years to come, do you think domestic inflow will outflow the foreign influence in the Indian markets?
I think so, and I think it's already happening, right? If you see the last 2 to 3 years now, because there have been in fact years where I think calendar year 22 or calendar year 21, in fact calendar year 22 itself and 23, FIIs were negative, there was outflow actually out there, whereas the domestic inflow was there, and this is one of the few rare years in my last 2 decades where I have seen where such large FII outflows and the markets have remained positive. So clearly the domestic flows are dominating, and I think it's a happy situation for all of us, as we should be proud Indians about it, because it's our markets and we would like our people to actually be investing in these markets and making long-term wealth for them, because the Indian businesses are doing fantastic. As we've seen over the last 10-15 years, the entrepreneurship has created tremendous amount of wealth for investors who have stayed with businesses for a longer period of time. So I think more the domestic participation, the better we have to see the color of this money. A good part of this domestic flows is SIP money, which is a very, very sticky money, right? So I think that is something what is something to be very, we are in a very good situation.
Okay. Of the stocks that you have invested in, which stocks do you think have been the capital builder in the real sense for you?
Yeah, I think that's a good question, because Capital Builder has now a 11 plus year track record. It's in fact 11 and a half years. 30th of September will complete 11 and a half years since the time I took over this portfolio from 1st April 2013, and we are in 30th September 2024. So it's good 11 and a half years, which is a good time frame to actually reflect back and see, have we done justice to the thought process that we had when we actually initiated this strategy. And our thought process from day one has been the game of compounding. And when you talk about capital builders, which is the compounders in the portfolio, so I am very, very satisfied in when I say this, that the vintage in the portfolio is very strong. Nearly the top 40% of our portfolio is now 10 years plus of vintage, which means we've been owning these businesses for now 10 plus years. The next 35% of the portfolio is now 7 to 10 years of vintage, which means the 75% of the portfolio, or almost the 3/4 of the portfolio, okay, is now with a vintage of 7 to 10 years in this portfolio. So companies like Divi's Laboratory, companies like ICICI Bank, companies like Sundaram Fasteners, companies like HDFC Bank, companies like Nesco, companies like Mahindra Holidays, and I'm giving you names across sectors. I'm giving you names across large cap, mid cap, small cap. So we've been fairly sector agnostic, we've been fairly size agnostic, but these are businesses which have been a part of our portfolio from day one till now, and we haven't really tinkered too much with the holdings. And this is where the compounding effect has actually played out. So that's why Today, Capital Builder has delivered nearly 19% compounded return over these last 11 years.
Great. And what would you advise investors looking to refresh their portfolio after a long period of stagnation?
No, I would say it's a function of, there are some very classic rules of portfolio management. First very important thing is keep your winners and sell the losers. So, which is very counterintuitive to what most of the investors generally tend to do, because they tend to book profits and keep on sitting with their losses. Actually, it's exactly the other thing that one needs to do for portfolio wealth creation. There was some global, in one of the countries, I think mostly US, there was some research done, and they figured out that the best portfolio wealth creation has happened with people who died and their portfolios were not looked at for the next few decades, and they had some of the best portfolio returns, beating most of the active fund managers. So actually just because the portfolio is not being active doesn't mean it's bad, because it actually allows a natural way of allowing the winners, as long as you have the right businesses with strong quality of management, businesses, the basic fundamentals. I don't think there is any, because otherwise you are only doing activity rather than trying to, because there's no need to be anything like over smart. You just have to be smart enough to say avoid the wrong things.
That's great insight. So rapid fire round for you: bullish, bearish, or neutral? Ready? Okay, retail and consumer goods?
Bullish.
Real estate?
I would say good for promoters of those companies.
Okay, that's diplomatic. Infrastructure?
Good for the country, critical for India.
Automotive?
Positive.
Technology sector?
Bullish.
Telecommunications?
Bullish.
Financial services?
Selectively bullish, as I said, private sector.
BFSI?
Very similar, again, private sector.
Wonderful. So this has been real good information, Sachin, and thank you for being on the show. Thank you, viewers, for being with us for this episode, and stay tuned for more. Thank you.
Thank you.